Jud Pyle of PEAK6 Investments, and we also have with us Michael Mullaney, a portfolio manager, Fiduciary Trust Co. He told Bloomberg News in mid-April that stocks would pull back, and they've dropped almost 10% since then, so he was right. Mike, I'm going to start with you. So Jim Bianco telling us that he doesn't see any kind of rebound in the near future, and that's why he's defensive. I'm assuming you think he's got it right.
Yeah, we do. We think the market's going to struggle now for the better part of, take 2 months, let's say. During the January correction that we had the luxury of earnings season right upon us, and it was a great earnings season for Q1. We're going to have to wait now until July for the numbers to start coming out for Q2, and we think the market's going to be more exposed to probably macroeconomic shocks over that time frame.
So what do you think we're looking at as far as continued correction? I mean, down 10% already. Do we go down another 5, 10, 15% from here?
Well, critical level is that 1055 on the S&P 500 because that's what the bulls want to see as a double dip or double bottom, basically, as far as stocks are concerned. So it's got to hold 1055, which it bounced off pretty well on Friday. We've got another gap resistance coming up at 1090, where there was a lot of volume right about that level. So if we can get beyond 1090, we might have some smoother sailing, but it's still a long way to go.
Mike, what do you say, though, about those people who say there's some strong U.S. fundamentals out there? We had existing home sales numbers that came in well. I know there's the tax credit from the government, and that's certainly been a push behind these numbers. But many people come on and say, you know, the economic backdrop here in the U.S. is not too bad here. So what do you say to that argument?
It's not bad, but it's not great. Usually this symmetry between corrections and recoveries. We had a very strong, obviously, recession, the Great Recession, as it's being called. And you would like to see the GDP growth numbers coming out of that in a 7, 8 handle. And what we've had is we had one 5.6 print and one 3.2 print, which is not that great. So while it's been a recovery, it's not been that robust.
And we're seeing a survey, the NAB, expecting 3.2 as well for the average over 2010 and 2011. Jud, let me bring you to this discussion and ask you about the key levels. Michael mentioned 1025 here for a double bottom. What do you think the key levels are watching the S&P 500 here?
Yeah, it's definitely 1055. We've bounced off of it a couple of times, and if we go through there, I think it's going to be a lookout below, and then you'll have to be checking for the next resistances. Today's close, this is looking ugly. I'm very disappointed with the last 45 minutes. So as you look at it from a technical standpoint, I certainly wouldn't be dipping my toe in the pool, and I'd be looking more like, you know, tomorrow could have kind of an ugly open just based on the way this close goes.
Jud, what's going on though here? You know, we're looking at the markets here, and we again just took another quick leg down. We're now down about 111 on the Dow Industrial. So what's going on here? Well,
it's, you know, to put it simply, more sellers than buyers. However, remember, of the big rally that we had on Friday, we were unchanged with about 35, 40 minutes to go, and then it could have just been an air pocket getting back there. So we're really giving back the gains from Friday, and I think that you just have selling pressure. There is an increase in risk aversion, and when that happens, the buyers kind of just get out of the way. But one thing I will point out here is take a look at the CBOE Volatility Index. Even with the market lower, that VIX was lower a little bit. So people are forecasting that, hey, we might be heading to the downside, but the size of the moves might be a little bit smaller than what we've had for the last week.
Let me get back to Jud and Michael. Michael, let me ask you first, what's your take on the momentum that we're seeing? It seems like down is the direction unless there's any reason to go up, and previously it was the other way around.
Well, it's a perilous market, and except for the most savvy day traders, you probably want to stay away from this. The market is way oversold on a near-term basis, whether you look at the 200-day moving averages across a lot of stocks or the 50-day moving averages across stocks. You'll see there are a lot of below that right now. RSIs are very, very low, so you can expect a bounce in any day, but that's what it'll be. It'll just be a bounce.
Hey, Mike, it's Julie here. I'm just asking if you're not looking at stocks right here as terribly attractive. We've seen a lot of money go into gold. We've seen money go into U.S. Treasuries. Is that where you're allocating your assets right now also?
We've done gold in the portfolios already. We've got about a 2% position across all our portfolios as an insurance head against, once again, macroeconomic shocks that might be coming across. We're also in our aggressive accounts looking at adding the VIX ETN, the VXX, which will be an inverse correlation, obviously, to prices as far as the S&P is concerned. That's on the table right now. And we've generally taken money out of small cap and emerging markets to rotate back into the larger high-quality stocks and hedge funds also within our portfolios.
Hey, Jud, you know, with all this increased volatility in terms of strategy, I know you guys, you traders on the floor, like the volatility. But let me ask you, how how much more of a correction? We're already down about almost 12% since April 23rd on the S&P 500. An earlier trader said he's looking more for like an 18% correction. What are you expecting here?
Well, I think as we talked about earlier, Carol, if we blow through 1055 on the S&P, then I easily see us going down and testing the 1,000 level, just because it's psychologically it's there. And I think that's part of the reason why your earlier guest said 18%. And you know, I'm still a believer that by the end of this year we're going to be back around unchanged on the year, which would be 1115. But as Michael pointed out, we're going to go through periods like we are now where there are more sellers than buyers, and people need to pick their spots. For longer term investors, if you've been dollar cost averaging, I wouldn't stop. But if you're a, you know, if you're a day trader trying to flip things, the long side isn't probably going to make money unless you're watching it very closely. And I do like the idea of the large mega cap stocks with good price to earnings ratios. There might be some bargains out there now.
Man, you guys sound like two bears. Michael, you calling yourself a bear?
On a near-term basis, we're bullish at year-end. We have more construction than Jud is at year-end. We still see, we're hoping, maybe a 1250 print for the S&P 500 by year-end, based upon earnings still coming through for the second, third, and fourth quarter.
Jud, you were nodding. So are you calling yourself a bear yet, or what?
No, you know, I'm a near-term bear. I'm a long-term bull. And I think that we can get back to unchanged on the year, and we can, you know, have a 5 to 10% gain at the time. But right now, it's very rational what's going on. There's plenty of bad news out of Europe, lots of fear, and that's why we're seeing the increased risk premiums.
And Jud, let me ask you about the VIX here, because I noticed obviously there was a big pop on Thursday, but it's come down since then. Where do you think it should be right now? What's fair value there?
Well, it's probably somewhere higher than with the moves we're having now. I'd say like 33-ish is probably where it will settle in here for the next week or two, and that's just a function of the size of the intraday swings that I think we're going to have. You know, even if you take a look at today, sure, where you were down 125 on the Dow, for example, but we were down 0.5%, then unchanged, down 0.5%. When all that happens, there's a lot of rehedging that goes along. So those intraday swings can make volatility be more in demand. I'd look for kind of the 33 level here in the short term over the next couple of weeks. Long term, we're not going to see a big rally until this thing starts to get consistently below 30 again, as people kind of take that fear out of the market.
What has to happen for that fear to come out of the market? Michael, what do you think? I mean, if we see Greece default and then reorganize, if we see the bank problems taken care of in Spain, Italy, and Ireland, I mean, is that what we need to have happen for things to get behind us?
You know, that would help. The default would be very, obviously, a shock to start off with, especially for the bondholders, obviously. But that may be the prescription that the doctor really needs to order. And it's a combination. We think things will be okay, but not once again until that July period when earnings start to get reported again, which we think are still going to be strong.
So, and that's enough to provide some gains later in the year, Mike.
Yeah, because you've got right now Q2 earnings and Q3 earnings are supposed to be in the mid-20s as far as growth is concerned, and then going back up to about 30% for the fourth quarter. We're a little suspect of that 30% in the fourth quarter because the primary driver of that is financials off a very weak 2009. We're not quite sure the financials are going to be that stellar that's embedded right down in that number, but still a good number. You get 3 strong quarters in a row of earnings. Stock prices follow earnings growth. It's just that simple, and we think that the stock prices will recover from that level.
Are you worried about the financial network in Europe? I mean, a lot of concern about whether it actually holds up or if we see a financial collapse over there.
Yeah, they need time. That's the biggest thing that they have to have on their side right now, because what they're going to have to do is that obviously a lot of the banks in Europe own a lot of both Greek paper, a lot of paper in general from the Club Med countries, and they're going to have to work through some of those positions because I've got a gut feeling that balance sheets are overladen right now with that kind of paper.
Hey, Jud, look ahead. We got a bunch of economic news on tap this week. More housing data. You've got GDP, and then of course it's a holiday week. We've got Memorial Day weekend coming up, so that certainly could impact volume. What other kind of key data points are you kind of keeping an eye on here?
Well, it is all about the economic data, but then also, as we said, what's going on out of China and Europe. The other thing that I want to be keeping an eye on is energy. We've got this whole sector now, whether I look at ConocoPhillips or Diamond Offshore today, everything from the drillers to the producers, those stocks have really gotten beaten up. If those stocks start to turn, that would be one thing that would definitely provide a positive catalyst to the market because they are such a large large percentage of the S&P 500. So I'm definitely watching oil prices and watching those commodity prices.
Yep, it'll all keep us busy. Hey, Jud, thank you so much. Jud Pyle there out in Chicago, and Michael Mullaney of Fiduciary Trust. Guys, thank you so much.